Hey everyone, I'm so excited about today's episode, but first want to let you know that this show is made possible by FortuneBuilders. I also want to take a minute to invite you guys to an amazing opportunity to learn from some of the top experts in the real estate industry about how to get started in real estate or scale an existing business to the next level. FortuneBuilders is hosting a one-day webinar to help you learn about real estate investing in today's market. So throughout the show, if you feel like you're ready to get started, go to FortuneBuildersShow.com to register. Again, that's FortuneBuildersShow.com to register. If you're watching on YouTube or Facebook, you'll find a link right below the show so you can get there that way as well. And please remember that the content of this show and every show is for educational purposes only. Myself or our guests are not going to be providing any legal, financial, or professional advice. If we share specific results, they are attributed to an individual or a business, and we can't guarantee the results will happen for you, those earnings or the income will match those figures. The bottom line is there's always risk when investing in real estate. You can make a lot of money or you can lose a lot of money, and it's hard work. But that doesn't mean we can't have fun doing it. So let's get into today's episode.
From a team that has $1 billion in real estate investment experience. A show to help you learn the strategies and systems it takes to get started investing in real estate. This is the Fortune Builders Real Estate Investing Show.
Hey everyone. Welcome to this week's episode of the Fortune Builders Real Estate Investing Show. Jeff Rakowski here. I'm going solo this week, and I'm excited about what we're going to get into today. I was actually having a talk last week with a group of people, not necessarily real estate investors, but it was a lot of concerns, a lot of questions around retirement. And I believe real estate is one of the best retirement plans. So I'm going to get into real estate as a vehicle for retirement today. But as always, let me hit you with the word of the week. This week, the word of the week is a defined benefit plan, also known as a pension plan. Some of you may be familiar with it. Some of you may not know what I'm talking about. And that's because there's not too many of them left around. And that's actually some of the things we're going to get into in today's show. But a defined benefit plan or a pension, my brother-in-law has one, for instance. He worked about 22 years for the West Haven Police Department in Connecticut. And when he retires, which he is about to here in a few months, he will have a pension plan that pays him a set amount of money per month for the rest of his life. They're actually really good. They actually put you in a position of cash flow, which is a great thing. Cash flow is what we want. The only problem is there's not many of them around today. So we need to switch to a different plan in order to secure a comfortable retirement. I don't think there's any other plan better than real estate. So let's get into today's show. All right. So a lot going on in the world. The Fed released last week that our inflation rate is at 8.5% nationwide, which is crazy. 8.5%. I don't believe that's accurate though, because they calculate that off of something they call the CPI, the Consumer Price Index, and originally inflation was intended to be calculated off the PPI, which is the Purchaser Price Index. So if you actually calculate it that way, I mean, we're north of 12% right now. So obviously inflation is having a big effect on Americans' lives all across the country, in a negative way and a positive way, I guess, if you own real estate. It actually breaks my heart. I see a lot of people that are, on fixed income, that type of thing, and just the prices of everything is going up. Well, maybe their income's only going up 3% per year. Obviously, if you own real estate, like we do, your heart still breaks, but at the same time, all of your assets, everything you own, real estate-wise, has increased in value immensely. And then for those of us that buy and hold properties, what we're able to, charge in rents have gone up. People don't talk a lot about that, but the focus in the media so much right now is on the prices of homes, going up, which they have. But actually, rents percentage wise have actually increased over the last 2 years at a greater rate than even the prices of homes. So, man, the top piece of advice I could give you still is just buy as much real estate as you can. I do not believe we're in a bubble. I mean, eventually there will be a correction. But what we're dealing with today, it's not 2008. The systemic issues that existed back then don't exist today, and we're still looking at record low inventory in our country. A lot of people that want homes and not a lot of homes available. Still simple supply and demand. We really have a housing crisis in our country right now, and really that actually goes back to 2008, in my opinion, where after the great financial crash, so many developers were gun shy and afraid to get out there and start building homes. But we have a massive, massive shortage right now in our country. But we're also, heading into an affordability crisis as well, because of that supply and demand, property values have gone up significantly. We still have cheap money. I mean, the 30-year fixed just broke 5%. The Fed a few weeks ago increased, rates by 0.25%, and they're supposed to meet 6 more times this year. And they did say, we'll see if they do it or not, but they did say in each of those 6 meetings they're going to increase, the interest rate by another 0.25%, and that's the federal interest rate. We understand that that's not, the actual mortgage rates, the money being loaned, but it does have an impact. So we'll see. But that's still cheap money, in my opinion, in our country. We've talked about it a lot on this show. Is still printing a lot of new dollars, which devalues the dollar, which also is playing a big part in inflation increasing. So with all of that being said, how do we position ourselves for success? How do we position ourselves, to retire comfortably? And to me, said very simply, I said it a moment ago, is let's buy as much real estate as we can. Now, there was a time in our country where, we kind of knock it, on this show, where we've been taught to work hard in school, get good grades, get a good job, save our money. If we want a higher paying job, go back to school, get a better degree so we could get paid more money. And we've always talked about that in a negative context, because it's really not working in our country. But there was a time in our country where, that was some solid advice. And there was a time, as many of you know, and maybe some of you experienced this, where you could work 20 years for the same company, and then, tap out with a nice pension plan and get paid every month, for the rest of your life. And that was our word of the week. And, defined benefit plans or pension plans, they started in 1875 with a company called American Express, not the credit card company, but American Express in 1875. And, up until probably the early 80s, probably about 90% of companies offered those. And at face value, they were very good things. If you traded 20 years of your life, 30 years of your life working for a specific company, then you were rewarded with monthly cash flow, really for the rest of your life. And you know how we feel about cash flow around here. Cash is not king. Cash flow is king. We want assets paying us on a monthly basis passively, whether we are working or not. But what happened, just to give you a little bit of a context and a background, is it worked out great for the employee. So as I just mentioned, 20, 30 years of your life, then you get this monthly check. So every month after the employee retired, that was monthly income. It was monthly cash flow. But if it's monthly income to the employee, that means it's a monthly expense to the company that the employee had worked for. Not just a monthly expense, but they're not just doing this, or weren't just doing this for one employee. It was many employees. So it became a big liability on the financial statements of these companies. So I believe it was in the early 80s where they just began, companies began looking at, like, how do we get this off of our books? This is a huge expense. It's a huge liability. How do we get rid of this? And there's a gentleman by the name of Ted Benna. He's referred to as the father of the 401k. You could go look him up. But basically, he was hired by one of these companies or multiple companies, I forget. And basically, said, how do we get this off of our books? And so he found, in the IRS tax code, the 401k. And basically, through a series of events, the 401k was birthed and it was launched, and they put it out in the media as, God's greatest gift to the world. And many companies over time transitioned from the pension plan to the 401k. To today, it's less than 5% of Fortune 500 companies even offer a pension plan, where, years ago that was flipped to where most of them did. So the important thing to know, and I'm not going to get too deep into this on the 401k, but the important thing to know is that when companies switch from the pension plan to the 401k plan, essentially what happened for the employee is it switched them from a place of cash flow to a place of net worth. Now, that's a huge distinction, and that's what we're going to break down here quickly. But then ultimately, we're going to say, all right, how do we put ourselves back into a position of cash flow? So it's kind of like this, cash flow is, let's just say, you need $6K to live every single month. And you worked 20 years for a company and you got a pension that paid you $6K a month. January, you get $6K, February, you get $6K, March, April, May, every month, for the rest of your life. A position of net worth, which occurred with the 401k, means is, let's just say you have $18,000 in your 401k, and then you need, $6K to live. Then after month one, that $18,000 balance drops down to $12,000. Month two, it goes from $12,000 to $6,000. Month three, it goes from $6,000 to $0, where we kind of run out of cookies in the cookie jar. So the 401k basically is like hoping we can save up enough in that 401k and build it up enough to where when we retire, we could draw on that and hope that we don't die before that cookie jar runs out, so to speak. So when I look around at the status of our country right now, I was looking at some stats the other day. It was actually an article in USA Today. I'm looking at it right now. But it stated about 80% of Americans right now lack retirement planning basics. They don't understand it. They don't have the basics. 70% of Americans have no financial plan to retire. That's a scary thing. The median retirement savings account right now has an average of just $65,000. And the average American feels like they need over $1 million to retire. We've all seen those commercials, like Fidelity and Merrill Lynch and all of that. There's one, I forget the company, but you'll see, all these people walking around, and above their heads, they have a specific number. And that number represents what they need to save to retire comfortably. So I have a chart here in front of me. If you want to retire in 20 years and you need $10K a month to live on, then you need to save $3.4 million. If you're retiring in 10 years and need $15K a month to live on, that is $2.1 million. I'll give you one more here for you younger folks out there. If you're going to retire in 30 years, or let's say 40 years, and you need to live on, $10,000 a month or $7,500 a month, that's $7.8 million that needs to be saved. Now, the question, I always ask this when I'm teaching in a live event, if you need $3 million, $5 million, $7 million, how long on your current path would it take you to save that much money? And usually the answer I get in a live event is, never. I'll never be able to do that. Or, that it just takes either an incredibly long time, or the majority of the room will pretty much say, well, the path that I'm on right now, I'm just not going to be able to do that. And that is true. So the 401k, in my opinion, it's not even proven. I mean, it came out in the mid 80s. So just getting to that point where, people over the past few years, 5-10 years, have been, kind of depending on that as a retirement plan. But the biggest thing I want you to take away from that is the 401k is not putting you in a position of cash flow. It's putting you in a position of net worth, where you have to accumulate and save a certain amount of money. So then when you retire, you draw from that every month and hope that it doesn't run out. So let's just say, use an example that you need to save $3 million to retire comfortably. So in my opinion, there's two plans. One is you leverage things like the 401k, you save to accumulate the $3 million and then pay yourself $10,000 a month when you retire. What I prefer, and really the path that I'm on, and so many of us, here at Fortune Builders are on, is putting ourselves back in that position of cash flow by accumulating cash flowing assets. Real estate. Real estate is our primary vehicle, but there's so many different ways out there. I was talking to somebody about this morning. I'm a real estate guy. I love real estate. I'm passionate about it. He was doing some other things that are cash flowing for him, which is a good thing. But I don't care how you cash flow. I just encourage you to cash flow. I don't care if it comes from real estate or Bitcoin or ATM machines. I don't care where it comes from, but let's tap into cash flow. Real estate is the most proven asset class, to develop that lifestyle. I've talked about it numerous times on the show, but I think we're over 18 million millionaires right now in the United States of America. And, roughly, 60, 70% of them accumulated that wealth through real estate. So it's just the asset class. If you're looking at, what's going to give me the highest probability of success, it is definitely that. So that's why we're passionate about teaching and training people around here. Next, actually, we're going to be in Chicago here, in the immediate future. And we're going to have investors from all over the country. We're going to teach them how to make profits wholesaling real estate, how to make profits flipping properties, how to buy and hold rental properties, how to buy and hold commercial buildings. But the way we look at it is very simple, is flip a house, make a profit, invest a portion of that profit into a long-term hold, flip another house, invest a portion of that profit into another long-term hold. So, myself, I love single family homes. I love multifamily homes. I love commercial buildings. All of these things put me in a function of cash flow. So this is what we teach students how to do. And if you want to be one of them, you want to learn how to do that, I encourage you on every single show. We have free trainings we run every single week just to get you familiar with these concepts and understand where to start. I remember when I was on the outside looking in, wanting to invest in real estate, but just being overwhelmed by it, just thinking it was so far above my pay grade, so to speak. The more I learn over real estate throughout the years, I just realize, man, it's not that complicated if you understand the right formulas, and have the right tools. So that's what we do. So if you want to be, come to one of our free trainings right below this video, you'll see a link there, FortuneBuildersShow.com. FortuneBuildersShow.com, and that'll get you linked up to one of our free classes. But the advantages of owning real estate and fixing and flipping properties is great. Wholesaling properties is great. But if I could go back in time, I really spent the first 10 years of my career only wholesaling, only rehabbing. And if I could go back in time, the only thing I would have done different is I would have started buying long-term buy and holds sooner. I really got super active with that in 2014, and I've accumulated a good amount of properties and have nice cash flow coming from those properties. But I wish I had more, and I wish I did it sooner. I think that's anybody that's in real estate, especially over these past couple of years. Man, some of these properties have doubled or tripled in value, just since 2014, which is absolutely amazing. But I want to give you on a really high level, what I see as the four main benefits of holding rental properties. And really cash flow is one of them, right? So we buy an asset, that asset pays us on a monthly basis, or should pay us passively. And when I use the word passively, really what I'm referring to is not managing the properties yourself. We have many students in our community that do manage themselves. And hey, I'd rather have you own real estate, managing it yourself, than not own real estate at all. I just prefer it to be passive, to where it's set up is we place it in the hands of really high quality property managers. And really, my involvement is, making sure the mortgage payment, goes out of my account every month automatically, and then making sure my profit, comes into my bank account every month. So I probably spend, I don't know, maybe I don't know. I really enjoy it though, the spreadsheets and the numbers. So I probably spend more time than most, but I'd say I probably spend 2 to 3 hours a month, just evaluating my current portfolio, making sure that it's performing properly. But really, the majority, of the time is really how do I find more of it? But cash flow is definitely one of the benefits. Now, there are some larger companies out there that are buying properties right now without cash flow. I struggle with that. I remember a couple months ago listening to the interview. I believe it was the CEO of Blackstone. And the Blackstone's a big company taking down large portfolios, at one clip. But they're so bullish on the future value of real estate that they're buying properties that are essentially breaking even, not cash flowing. Because of the tax benefits that go along with it, because of all of that, but really, forecasting a future appreciation. So I'm no Blackstone. I'm a little more conservative than that. I'm personally not going to buy a rental property unless it's paying me every month. My philosophy is very simple, is I like value add investing, whether it's on single family, multifamily, or apartment buildings, to where I want to buy an asset from day one, it's paying me. And then my job is to make it perform better and pay me more. But I'm not breaking even. I'm certainly not going into the hole. So basically, cash flow is really what I want to see. And different investors all across the country have different goals. I know many investors are happy making $300-$400 a month. I know many investors that aren't going to touch a deal unless it's making them $3,000-$4,000 a month, and anywhere in between. So that's something where when I got started, I'd be buying smaller properties that would cash flow a couple $100 a month, and then over time I'm looking to do that more and more and more. But I don't know. To me, I'm never going to get too big to the point where I'm going to pass up on a property that's, passive, truly passive, paying me a couple $100 a month. I mean, why would we stop doing that, in my opinion? So cash flow's got to be there. And then another huge benefit of holding real estate is debt reduction over time. So we're big believers here in leveraging debt. As if you've watched the show before, you've heard that. I believe debt is the greatest accelerator out there to create wealth, that we could go leverage and borrow other people's money or banks' money to get into these properties with as little cash out of our own pocket as possible. But I remember the first property I ever bought that I actually still own it. I'm actually getting ready to 1031 exchange it into a larger building. But it was a property, I think it was like $126,000 that I picked it up for. And I acquired about $93,000 of debt. At the time, I think I only put 20% down on the building. So it was about $93,000, give or take, that I owed after buying the property. So I had a mortgage payment due every single month. But the beautiful thing is I wasn't paying it down with my own money. The tenant that was paying me rent, obviously, was paying down my debt. So that's a beautiful thing. Obviously, that's not money that hits our bank account every month, but I don't know I've refinanced that property, actually twice since I bought it. But over time, that debt reduces, increasing my net worth, and it's being paid off by somebody else. Now, I do encourage you, though, especially over the past couple of years, properties have appreciated so much in value. So I always carry the philosophy as an investor, always a buyer, never a seller. Meaning just hold forever, type of thing. But even myself, over these past 2 years, there's been properties, like I said, I'll be 1031ing, changing a handful of properties next year. So I'll technically be selling them, but going into larger deals. And I strongly encourage the 1031 exchange, by the way. And really what it does is it defers your tax liability. So if I sold that property outright without 1031 exchanging it, there'd be a portion of that profit subject to capital gains. And really, taxes are the biggest deterrent to creating wealth over time. So I'm able to roll all of that profit into another deal and not have to pay taxes. And then if I sell that building, I could 1031 exchange it again into a larger building and just keep kicking the taxes down the road. Type of thing. Even when I pass away, I could still own those properties, leave them to my children, and they could keep doing the same thing. So eventually, if somebody sells it outside of a 1031 exchange, taxes will be due. But that's one approach, that you can take. But I don't know anybody right now that's owned property for a couple of years that doesn't have equity in it. And the way that I view equity in a property is like having cash in the bank that's doing nothing for me. So if I had 100 grand sitting with Wells Fargo, growing at 0.25%, that's doing nothing for me because inflation is at 8.5%. So I'm actually losing money. So I need to get that money to work. And most people understand that, but I find many people don't look at equity in their homes as the same thing, where that's your money just sitting there, not doing anything for you. So definitely on rentals, even on your primary residence, I recommend equity stripping, where you're stripping that equity out, whether you're taking a second position home equity line of credit, at 3-4%, and then you're able to invest it and grow it at 10, 12, 15%. Or you're just recently I did an interest only cash out refinance. On a property that increased cash flow because you're just paying interest on a monthly basis. And I was able to pull out a nice chunk of money, at 2.25% was the rate that I closed at. And now I'm able to grow that money, at 15% easily. So that's just, one of the things I really love creating wealth that way and teaching other people how to do the same thing. So you have the cash flow, you have the debt reduction. And then another huge benefit of owning property over time is property appreciation. Now, like I said earlier, I'll never buy a property, that's losing money monthly, hoping that it's going to go up in value over time. We don't make buying decisions that way. But really, since the early 70s, since, our US dollar went off of the gold standard and we transitioned to fiat currency, properties have appreciated. The last chart I was looking at, it was right before the pandemic. So like January 2020. And it was like our nationwide average. It was a average of like 4.1 appreciation year over year since the 70s. Now, I understand that in that time there was really ups, there was crashes, all of that, but the average was, call it 4%, where properties have appreciated. And then again, that's not including the last 2 years, 2020, 2021, where property values just over the last year have appreciated something like 17%. So obviously that'll increase that 4%, but you're pretty much, it's not guaranteed. You can't guarantee it, but anything you buy today, I'm pretty confident over the next 10, 15, 20 years, it's likely to be worth more. But so again, you don't make buying decisions off of that, but that is one of the values. Everything that I purchased in 2014 until the current day, even properties I purchased 6 months ago, everything is worth more than I bought it for. That property I referenced a moment ago, $126,000, that is now valued at about $275. So so that it's just crazy. But again, you don't make buying decisions off of that. And then of course you have tax benefits. We've talked about a lot about that on this show, but you have everything from depreciation, where mortgage interest, repairs, insurance write-offs, local travel, long distance travel, where you own properties, home office, employees or independent contractors, repairs that need to be made on it. So, I mean, it's just huge values. Depreciation's a big one though. So I'm actually looking at, I was just pulling up here that $126,000 property that I was mentioning. So that's in Texas. And right now, Texas values that building at $112,000. And they value the land at $15,000. So in depreciation, you could write off the value of the building, not the land. So you would take that $112,000, divide it by the tax bracket you're in, and that would give you a dollar amount I'm sorry, you would take the value of the building divided by 27 and a half years. That's the amount of time that the IRS allows you. So in this case, 112,000 divided by 27 and a half years is $4,104. Then you multiply that by the tax bracket you're in, and that gives you your tax savings. There's also ways to do what's something called the cost segregation study, where you could depreciate parts of the home, this is really on commercial buildings. You definitely want to do the cost segs across the board, because there's certain items like fencing and HVAC and appliances and things like that you could actually depreciate at a faster rate, typically over a 5 to 7 year term, that give you higher savings. So this is my retirement plan. I'm just trying to buy as many properties as I possibly can, as quick as I can. That cash flow, that I get the debt paid off by somebody else, that over time it's pretty likely that they're going to go up in value. And then I just have a laundry list of tax write-offs that I can take advantage of on an annual basis. So it puts me back into that position of cash flow where, like I said, pensions, kind of kicked that off in our country, was a great thing for a long time. They're just really non-existent now. So we're able to put ourselves back in that position of cash flow via real estate. And we have other people's money. We have debt that we could learn how to borrow to buy as many properties as we can, as fast as we can. So that's my story, guys. I'm sticking to it. Hope you enjoyed this week's episode of the Fortune Builders Real Estate Investing Show. Good seeing many of you. It would be good to see many of you guys at the Chicago Boot Camp coming up. So come say hello. Let me know how you're enjoying the show, and anything more you want to see more of. We're trying to talk about relevant topics. We have JD coming in here all the time doing case studies. We're going to start bringing in some students and just walking through their journey and looking at some of their deals. But thanks for tuning in. Share the show with a friend, and we'll see you next week on the Fortune Builders Real Estate Investing Show. Take care, guys.